Are we facing the end of the bear market? What has caused this boost? What about the Fed pivot? Stay until the end and we'll tell you all about it. It has been a week of pro-crypto policy developments. The United Kingdom has voted in favor of the regulation of cryptocurrencies. Americans demand crypto regulation and policies. Singapore takes steps further regarding its pro-crypto plans. Looking at the macroeconomic picture, the European Central Bank decided to raise interest rates to 75 points. Somewhat expected, but what did Christine Lagarde have to say about this? The Fed could be forced to have to advance the pivot. What consequences could this have? If you're keen to learn more about blockchain technology, the crypto environment, and macroeconomics, follow us on Twitter at mundocrypto_en. Check out our website news.mundocrypto.com for further information. That said, let's jump into the technical analysis. In this daily Bitcoin timeframe, we can see how the price was in a lateralization phase with the possibility of breaking this minor trend line, which did end up happening on October 25th. On that day, we can see the harmony between effort and result, and it managed to break the trend line's confluence in addition to the $19,500 area, which had turned into a very important resistance. On that day, we saw a bullish engulfing candlestick, which was followed by the next day's candlesticks movement. The price headed into an important area mentioned in the previous analysis, following that mini range, which led into a larger range located between $18,400 and $20,550, which served as a resistance throughout this price lateralization. On October 27th, we can see how the previous movement failed to hold on, marking a full-bodied reversal red candlestick, a sign of indecision. Once Bitcoin touched the 21,000 mark, the price was rejected and fell back to the bottom of the aforementioned mini range. So watch out for any bull traps and short squeezes. If we take a look at the volume profile, we can see that the VPOC, or volume point of control, remains in the same area, $19,150, although there's been some developments. Despite not being very relevant, now we can see a small buying and selling interest area in the upper part of the range, above $20,900. The next important area of buying and selling interest sits at approximately $20,100. After seeing how the price broke the minor trend line as we discussed earlier, now there's different possibility. For this upward movement to continue, we'd have to see a bearish movement towards the area between $20,000 and $19,700 to then bounce back and throw back in $20,500 area, and then go on to test the new resistance from $21,600 up to $22,500. Otherwise, if we don't break above the $20,500 area, the price could drop down to the $20,000 area, pull back, and once again head towards the $19,700 area, where it meets the previous minor trend line or even reach that control point. In this SP500 chart, we can see the move discussed in our previous analysis. If it were able to win the lower trend line, we would see a breakout move, a throwback, and a continuation move towards the upside, heading toward the intermediate bearish trend line, where its value was rejected in the 3,860 point area. After linking three bullish candlesticks on October 26th, we can see a long-legged doji candlestick that, in this structure, has a very bearish connotation. As we can see, the volume in this area begins to decrease from the previous day, and despite increasing on the 26th, it ends up forming a higher spike on the candlestick, which is where it touches the intermediate bearish trend line. This was followed by a bearish engulfing candlestick with greater volume input. These three candlesticks could be considered to form a sunset doji pattern, which will be confirmed depending on the candlestick formed this Friday, the 28th. Following this, we can see a move similar to that of Bitcoin, with a pullback that forms a kind of double top and heads towards that bearish intermediate trend line once again. If it fails to consolidate the area of 3,840 points, it would fall back to the area of approximately 3,680 points. In a bullish scenario, today's candlestick would not have to close below 3,700 points, and there would have to be a rebound in the SP 500 to try win the bearish intermediate trend line. After this, we would see a throwback and a continuation move to the upside that, if it's strong enough, could make it to the 4,000 point area and head towards the main downtrend line. In this US dollar strength index, we can see a minor bullish trend line made up of 5 helium waves with successive impulses and corrective waves. Taking a closer look, this week the pattern discussed in our previous analysis started to form. There was a possibility of seeing a flat with failure in wave C as the 111,840 point area was not lost. When placed below that area, a normal continuation flat formed and moved towards the area of 109.4 points, where it converged with the minor bullish trend line. Here we can see how perfectly wave C correlates perfectly with the movement of wave A, which is known as a normal flat. With the important confluence in the 109,000 point zone and the confluence with the trend line, we can see an instant rebound, and that has caused a correction that we have been seeing since yesterday. This movement has led to higher projections. These projections would take us back to the 111,800 point area, a consolidation and a throwback in search of trend lines of 2008's greatest parallel channel. All of this only if it is capable of exceeding the 110,900 point area. Let's kick off with the United States. The manufacturing PMI sits at 49.9 compared to the forecast of 51. In September, it sat at 52, the lowest mark in the last 28 months. The manufacturing production index has risen by 0.1 in terms of September's 50.7, the highest rate in 5 months. As for the services activity PMI, the figure has dropped below 46.6, sitting at 49.2, down 2.7 points. The S&P Global Composite Purchasing Managers Index was worse than expected, 47.3 compared to 49.3, down by 2.2 points since September. On September 25th, the Consumer Confidence Index in the United States was published, and the result was worse than expected, sitting at 106.5. This is no surprise given it's been falling, broadly speaking, since June 2021. In short, October has experienced a drop following consecutive monthly gains. As mentioned, the index currently sits at 102.5, down from 107.8 in September. Moving on to the real estate market, the US new home sales data is better than expected, 603K above the expected figure of 585K. September new single-family home sales this year were at seasonally adjusted annual rate of 603,000, according to publishing estimates. In other words, 10.9%, down from August's revised rate of 677,000 and a 17.6% below the September 2021 estimate, which was at 732,000. In terms of unemployment, on October 27th, the initial unemployment data claims in the United States were published, sitting at 214,000, a better than expected figure of 230,000. But in the week ending October 27th, the anticipated seasonally adjusted initial claims figure was 217,000, an increase of 3,000 from the previous week's unrevised level of 214,000. The 4-week moving average was 219,000, an increase of 6,750 from the previous week's unrevised average of 212,250. Overall, we're seeing a sustained full employment labor market. The important data due to the current situation is that of the United States GDP, a figure that reflects a growth of 2.6 above the expected 2.4, and that consequently moves away from the range of what is considered a technical recession. Now let's talk about the UK. Keeping in mind the data published on October 24th, here's the PMI. The preliminary data of the Composite Purchasing Managers Index has been worse than expected, 47.2 compared to 48.1, the lowest of the last 21 months, nearly 2 points less than that of last September. As for the manufacturing PMI, the preliminary data places it at 45.8, much worse than the expected 48, also worse than the 48.4 in September, the lowest point in the last 29 months. UK Manufacturing Production Index sits at 45.6, up from September's 44.2, 3-month maximum. For its part, the PMI for services activity displayed a preliminary figure of 47.5, worse than the expected 49.6, 2.5 points below September's 50, lowest in 21 months. In the Eurozone, let's start with the Manufacturing Purchasing Managers Indices, the German PMIs, and S&P Global. The preliminary data is worse than expected, 45.7 compared to 47, lower than 47.8 of September, marking the lowest point in the last 28 months. For its part, the Manufacturing Production Index sits at 42.5, 4.5 points below the September index, the lowest in the last 29 months. As for the PMI index for services activity in Germany, it sits at 44.9, slightly better than the expected 44.7, although in general terms it continues to decline, down by 0.1 compared to September, lowest in 29 months. And finally, the Composite Purchasing Managers Index was 44.1, worse than the expected 45.3 compared to September. It fell by 1.6 and marks the lowest point in the last 29 months. Something similar happened in France, and consequently, the general PMIs in the Eurozone are as follows. The PMI index, composed of the total activity of the Eurozone, stood at 47.1 against the expected 47.5, 1 point less than in September, marking a minimum in the last 23 months. The PMI index of business activity in the services sector was as expected, 48.2, lower than September's 48.8, marking its 20-month low. And finally, the manufacturing PMI index sat at 46.6, worse than expected, 47.8. 1.8 points less than September, lowest of the last 29 months. The production index of the manufacturing sector in the Eurozone stood at 44.2 compared to 46.3 in September, marking a new minimum in the last 29 months. On October 25th, the IFO Business Climate Index was published. In Germany, the data was better than expected, but it is only a short-term joy, as it has been falling since June 2021. Sentiment in the German economy remains gloomy. The IFO Business Climate Index fell to 84.3 points in October, down by 0.1 from September. Businesses were less satisfied with their current business. Their expectations have improved, but they remain concerned about the coming months. The German economy is facing a difficult winter. One of the most important fundamental developments in recent days was the decision of the Governing Council to raise interest rates of the European Central Bank by 75 basis points. This is the second consecutive month that it has done so, placing them at 2%. They do not seem to care about a possible recession and what it may entail for employment, families, and companies. Following this decision, Christine Lagarde spoke at a press conference, stating that there are several interest rate hikes in the pipeline. How much the rate hikes are going to rise in December remains a mystery, opening up a possibility of a rise of 50 or 75 basis points, although it has been said that we have already reached the neutral interest rate. The decision will depend on, according to Lagarde, the data they collect between now and the next meeting. How far they will go or to what extent remains unclear. The Governing Council has also decided to modify the conditions of the third series of longer-term financing operations with a specific objective, as the generous interest rate offered at the height of COVID-19 pandemic now allows banks to make a guaranteed profit at the expense of the Central European Bank. They do not see the recessive scenario as most catastrophic. In fact, she said, we're not in that situation, but neither is it one that generates economic growth. In short, PMIs are the leading indicators of overall company performance. This data reveals that the business contraction has been in constant decline since the second quarter of 2021. As for the labor market in the United States, it currently does not seem to decrease. The GDP outcome is better than expected, but let's not forget that it is a late indicator and the PMI data is not at all encouraging. So we'll have to wait and see what happens. We'll also have to wait and see what happens with the following data. Bounces and bull traps in bear markets are quite common, so be careful. Fixed resale also suffered rebounds, generating a state of tension. In terms of earnings, Google's outcome was worse than expected. Meta was mixed and still dropped in price. Amazon also saw a mix of results, and Apple a little better than expected. We'll have to see how these last two do, but for the most part, they've been positive. However, even though we're seeing better than expected data, such as that of Microsoft, it is normal for revenues to grow even if there's a little better demand due to the highly inflationary environment. And although in the USA we may have seen ceilings in inflation, the recessive environment will be the new problem, even if the GDP data keeps us away from a technical recession. In fact, data on GDP and the labor market continues to hint at a continuation of the hawkish position, although the enormous yield on government bonds may lead to otherwise. We have to see what Powell decides on November 2nd regarding interest rates. And finally, what's with the possible pivot of the Fed? There was a movement of liquidity towards risky assets due to this possible pivot. If you want to understand what a pivot is and what could cause it, check out our Twitter account. On the other hand, the Central Bank of Canada has decided to reduce rate hikes from 0.75 to 0.5, citing the Fed's pivot perspective. But let's not forget that although this is the case in the United States, which wasn't the case in the European Central Bank yesterday, even while they're more likely to face a recession, it does not necessarily have to be positive, as it could mean that something has broken on the way. In addition, interest rates rising to a smaller extent does not imply the start of a bull run. Why? Well, historically and according to statistics, bear market bottoms have occurred after these pivots and at a time when rates began to fall, not while they continued to rise, although to a lesser extent. This can be seen in the following chart, which is worth more than 1,000 words. These rectangles with a light grey background reflect the recessions derived from the previous crisis. The blue line represents the yield of the 2-year sovereign bonds in the United States. The black line demonstrates the effective Fed fund rate, which is the interest rate at which depository institutions exchange federal funds, and which basically mimics interest rates. And finally, the red line represents the S&P 500 price. Here we can see with more clarity what happened after those pivots. This chart measures the 30-day change in buying power of stablecoins from exchanges. Consider the 30-day change in major stablecoin supplies on exchanges, USDT, USDC, BUSD, and subtract the 30-day USD denominated change and Bitcoin and Ethereum flows. Positive values and bullish trends indicate that a higher or increasing volume of USD stablecoins is flowing into exchanges relative to Bitcoin and Ethereum over the past 30 days. Overall, it suggests that there is more stablecoin dominated purchasing power available on exchanges relative to the two main assets. In terms of the amount of short positions liquidated in the derivatives market, the liquidation is closed voluntarily or closed by force and comes with the bankruptcy procedure, margin calls or stop limits. The number of liquidated short coins could suddenly increase due to a sharp increase in price, and this could trigger additional liquidation, resulting in a short squeeze. As we can see in this metric, one of the most relevant factors that have propagated this upward movement is the number of short liquidations that have taken place for a value of 16,143 bitcoins on October 25th and 15,953 bitcoins on October 26th. That hasn't occurred since December 2020. However, while many believe so, it does not imply that we're going to witness a movement such as the one we saw back then, as the current situation is very different. It is true that if we take a look at the percentage of exchanges, their exit rally continues. We're seeing less and less Bitcoins in exchanges, 12.21% on October 19th. We'd have to go all the way back to June 2018 to see something similar. If we zoom in a bit, we can see how since October 19th, there is a slight jump to 12.29% in terms of those reservations. It seems like a small percentage, but let's take a look at the following metric. The one that measures the volume entering and leaving exchanges, in other words, the net flow of currencies that enter and leave exchanges. Following the significant outflow of Bitcoins, which, backed by that number of liquidations, encouraged this bullish movement, we can see a greater number of inflows. In short, keep an eye out in the short term, as in the span of 2 days, it adds up to 14,000 Bitcoins. Transfer volume has also experienced a significant drop, hovering around $19.2 billion per day. This leaves us below the peak transfer volume seen in December 2017, so slightly above the lows seen from May to July 2021. It indicates a considerable degree of apathy on the Bitcoin network, and the fact that the activity within the blockchain remains so low shows that the use and focus on the network is subdued, and the user base growth leaves a lot to be desired. Within the blockchain, things are extremely quiet. If the non-zero balance address account breaks below 42.6 million, it would mean a very significant purge of portfolios taking place, indicative of distribution and market weakness. If we take a look at the heat map, we can see after breaking the important cluster area at $20,000, the price headed towards the upside, triggering many limit orders. At $21,100, we can see a huge positioning to stop the price. They made it, and upon reaching that area, the price began to experience corrections. As mentioned previously, in that purple square located between $20,000 and $20,100, there's a very important area of long positions, turning this area into the most relevant one to watch out for in the short term. With all of this information at hand, will the momentum continue? What do you think is the Fed's next move? Is the bull run on its way, or is the worst yet to come? Let us know in the comment section below. With all of this information at hand, will the momentum continue? What do you think is the Fed's next move? Is the bull run on its way, or is the worst yet to come? Let us know in the comment section below.